Most people saving aggressively for 6 years end up with $101,000, and 77% of it is pure savings. Your investments barely matter at first. Your savings rate is everything. You've been told to invest more. The data says save more first. Buying 2 ETFs for diversification? They could share 92% of the same stocks. You think more ETFs means more safety? It doesn't. US stocks held for 20 plus years, zero real negative returns. Every single time. The market was overvalued by 50% in 2012. S&P was at 1,400. People who waited for a correction in 2012 missed a decade of gains. That guy in the BMW outside? He probably can't afford it. The people who look wealthy usually aren't. Being average with money, consistently, puts you in the top 5%. One simple rule cuts your bad purchases almost immediately. If you can't buy it twice, you can't afford it. A $500 purchase that makes you nervous about $1,000 means you can't afford $500. Delayed gratification isn't sacrifice. It's compounding your future self. Every dollar you save today is worth far more compounded over 30 years. Your neighbor's financial decisions tell you nothing about yours. Risk that destroys your neighbor might be completely fine for you. The system isn't designed to make you wealthy. It's designed to make you spend. Nobody shows you their real bank balance. Social media is highlights only. Boring investing beats 92% of professional active fund managers. One ETF, diversified, held for decades. That's the whole strategy. You don't need complexity. Complexity is often a distraction from discipline. Your expenses, savings rate, and net worth. 3 numbers, total clarity. Most people track 0 of the 3, then wonder why nothing changes. Fixed expenses above 60% of income, you're already underwater. Start at 10% savings rate, then ramp it. Every percent matters. Financing a depreciating asset at high interest? You're paying to lose money. $2,000 couch becomes $200 on resale in 3 years. That's $1,800 gone. Cars, jewelry, clothes, smartphones, all losing value the moment you buy. The borrowing cost turns a bad purchase into a financial disaster. Rich people buy assets. Everyone else finances liabilities. Zooming out 10 or 20 years makes almost every major decision clearer. Short-term thinking costs you. Long-term thinking compounds you. That 20K salary bump looks great now. In 20 years, it could be a trap. Compound interest doesn't care about your feelings. It rewards patience. The 30K millionaire trap is everywhere. Most people fall for it. Earning 30K and acting like a millionaire leaves nothing to invest. Most millionaires don't look like millionaires. That's the whole point. 10 financial rules, 1 video. Your first 100K depends on the first 3. Before we go deeper, 2 things most finance channels won't admit. Stay with me. The data in the next section breaks conventional finance advice. First admission, saving is boring. Second admission, it works every time. The people who got rich quietly, they started with discipline, not luck. Here's the system, and it starts somewhere nobody tells you to look. Lesson 1. Delayed gratification isn't advice. It's a mechanical wealth accelerator with a documented track record. If you buy and hold the stock market for 10, 20, or 30 years, the data says your gains keep compounding. Every finance expert who says don't touch your 401k is telling you the same thing. Time is the multiplier. The rule is simple. If you can't buy it twice, you can't afford it once. That's the whole test. This rule works because it forces you to assess your actual financial position, not your emotional one. Zoom out 10 to 20 years on any major career or money decision. The right answer usually becomes obvious. Lesson 2. Track 3 numbers: your expenses, savings rate, and net worth. Nothing else matters as much. Fixed expenses, rent, transport, utilities, insurance, should stay under 50 to 60% of your income. If your fixed costs eat more than 60%, there's almost nothing left for savings or investments. For discretionary spending, check in on the 15th of each month. You should be at roughly half your monthly target. If you've spent $900 by the 15th on a $1,500 budget, you know to pull back for the rest of the month. Start your savings rate at 10% of income. Increase it every 6 months. Treat it like a subscription you raise. Meet Alex and Jordan. Same salary, same city, different money outcomes, and the gap will shock you. Alex tracks the big three, saves 20% monthly, invests in a single S&P 500 ETF, boring and relentless. Jordan spends 70% on fixed costs, finances a car, checks Instagram constantly, tracks nothing. Net worth, tracking it isn't about obsessing over money. It's about watching your financial life improve over time. In 5 years, Alex's net worth is $87,000. Jordan's is $4,200. Same salary, zero luck involved. Here's the first reversal. Most people think their income determines their wealth. It doesn't. Your savings rate and expense discipline determine your wealth. Income is just the input. Lesson 3. You don't need 10 ETFs, you probably need 1, maybe 2, 3 at most. Vanguard's S&P 500 ETF, VOO, and Vanguard's Mid-Cap Value ETF, VOE, share 92.1% of the same holdings. You buy both thinking you're diversifying. In reality, you're just buying the same 500 stocks twice. According to S&P Global, casual index fund investors outperformed 92% of large active fund managers over 15 years. The professionals with Bloomberg terminals and teams of analysts, most of them underperform a boring index fund. Complexity in investing often signals anxiety, not intelligence. Simplicity backed by data wins. Stay with me, because Lesson 4 reveals a purchase mistake that silently drains wealth for years. Lesson 4. Depreciating assets financed with debt are the single worst financial decision most people make repeatedly. Cars, clothing, electronics, furniture, all depreciating the moment the transaction is complete. You borrow at high interest to buy something losing value. You're paying the bank to get poorer. A $2,000 sofa financed at 19% APR is worth $200 in 3 years. You paid more than $2,400 total. If you must buy depreciating items, pay cash. Eliminate the interest rate layer entirely. Now here's where Alex and Jordan's paths start to diverge even faster. Watch what Jordan does next. Jordan finances a $28,000 car at 7.5% interest, $380 per month for 5 years, and it depreciates 20% year 1. Alex takes that same $380 per month and invests it in an index fund over 5 years at 10% returns, $29,000. Jordan has a car worth $14,000 and $0 invested. Alex has $29,000 in index funds. Same income, same timeline. This is where it gets really interesting, and this part breaks everything most people believe about market timing. Lesson 5. If your investment time horizon exceeds 20 years, the historical data says you essentially cannot lose in U.S. stocks. The research from Of Dollars and Data shows, over every 20-year window, U.S. stocks have had no real negative returns, including dividends. Even if you bought at the worst possible moment, highest P/E ratio, holding 20 years still produced positive returns. The scatter plot shows, as holding years increase from 5 to 10 to 20 to 30, negative return scenarios vanish entirely. The second reversal. Waiting for the right time to invest is statistically worse than always being invested. In 2012, financial media said the S&P 500 was overpriced by 50%. The index sat at 1,400. It proceeded to more than triple. Every year, someone publishes a credible argument that markets are overvalued. They've been saying this since the 1990s. Over a 30-year hold, returns across all entry valuations historically converge. Patience removes the valuation risk. The mechanism isn't magic. You're buying fractional ownership of the most productive companies on Earth. Time amplifies that. But here's what nobody talks about. The real wealth destroyer isn't market volatility. It's the first 100K. Lesson 6. Saving is always important, but before 100K, it is the only thing that actually matters. Data from the 4-Pillar Freedom blog saved $13,000 per year at 7.5% returns. After 6 years, you have $101,000. Of that 101K, 77% is pure savings. Only 23% is investment returns. This is the critical reality of early wealth. Even at a 10% return rate, saving $10,000 per year, savings still comprise 67% of your $104,000 balance after 7 years. Every dollar you save early is worth exponentially more decades later. Not metaphorically, mathematically. The real wealth inflection point is after 100K. That's when returns start to outpace your contributions. Before that point, there's no trick, no shortcut, no clever hack. Just relentless, aggressive savings every month. Lesson 7, and this is the best one. Being average with money for an above-average amount of time puts you in the top 5% of all investors. Morgan Housel, author of The Psychology of Money, puts it perfectly. Forget your investment account password. The best investment behavior you can exhibit over 30 years is choosing to do almost nothing. Buy, hold, contribute, repeat. Day traders and active managers, they introduce noise that kills returns. Patience is the entire edge. The third reversal, excitement in investing, is a warning sign. Boredom is the signal you're doing it right. Dollar cost averaging, investing a fixed amount monthly regardless of market conditions, removes emotion from the equation entirely. Alex does this automatically. Jordan checks the market daily and delays contributions, waiting for a dip that never comes. By year 10, Alex is ahead by $43,000. Not because of skill, because of repetition and patience. There's something even more damaging than bad investing. It's the comparison trap, and it's cost people billions. In a few scenes, I'll show you exactly what the comparison trap costs per decade, and it will break your assumption about lifestyle spending. But first, the stealth wealth principle, and why the most financially secure people are invisible to you. Lessons 8 and 9 together form the mindset layer, and most finance content never goes here. Lesson 8. Stop comparing your financial situation to other people. This isn't motivational advice, it's mechanical. Comparison drives impulsive spending, which directly destroys your savings rate. Social media is a financial trap. Everyone shows you the purchase, nobody shows you the debt or the depleted savings account behind it. Everybody has a different financial baseline, different obligations, different goals. Your neighbor's investment might be your disaster. The moment you stop comparing, impulse purchases decline measurably. More of your income becomes available for wealth building. Lesson 9. The 30K Millionaire. This is the wealth trap hidden in plain sight, dressed in a lease and a VIP section. The 30K millionaire earns $30,000 but spends like someone earning $200,000. The gap between appearance and balance sheet is enormous. The Millionaire Next Door research is clear. Most actual millionaires live well below their means. That's precisely how they got there. The book's defining quote, "If your goal is financial security, you'll likely attain it. If your goal is to look wealthy, you never will." Stealth wealth is not about deprivation. It's about redirecting the social status budget into the compound interest engine. Here's what the comparison trap actually costs. $500 per month in lifestyle inflation, invested instead at 8% over 30 years, becomes $680,000. That's the comparison trap cost, is $680,000 in foregone compound growth. Per household, across a working life. Now the complete system. 10 lessons, 4 categories. Here's how they stack together into one coherent wealth architecture. Layer 1. Foundation. Delayed gratification, and the big 3 numbers. These make every other lesson possible. Start tracking expenses today. Free spreadsheet, a notes app, anything. The act of measuring changes behavior immediately. Layer 2. Asset mechanics. Avoid financing depreciating assets. Pay cash or don't buy. Every financed liability compounds against you. Before any major purchase, run the buy it twice test and ask if this is an asset or a liability. 2 questions, 2 seconds. Layer 3. Market strategy. 1 to 3 ETFs maximum. Dollar cost average every month. Hold for 20 plus years. Do not check it obsessively. Check your holdings quarterly, not daily. The data shows over-monitoring correlates with worse performance due to emotional overtrading. Layer 4. Mindset. Stop comparing. Avoid the 30K millionaire trap. Apply a personal risk filter to every financial decision you make. Lesson 10. Risk is deeply personal. What's reckless for your neighbor could be entirely rational for you based on your timeline, income, and obligations. Generic financial advice from YouTube channels, TV, social media is a starting point, not a prescription. Apply your own filter every single time. 25-year-old with no dependents and 40 years of runway can hold more equity risk than a 55-year-old with 3 kids and a mortgage. Same advice cannot serve both. Your financial plan must reflect your actual life. Not a template, not an influencer strategy, not your coworker's portfolio. Now let's put the full system into a practical sequence you can act on starting this week. No theory, just steps. Step 1. Open a spreadsheet today, or use a free net worth tracker, and log your expenses, savings rate, and current net worth. Step 2. Calculate what percentage of your income goes to fixed expenses. If it's over 60%, you have a structural problem before anything else. Step 3. Automate a savings transfer on payday, even 10% to start. Automation removes willpower from the equation. It just happens. Step 4. Choose 1 to 3 low-cost index ETFs aligned with your risk profile. Set up automatic monthly contributions. Walk away. Step 5. Apply the buy it twice rule to every purchase over $200. If it fails the test, wait 72 hours. Most impulse cravings disappear. This system requires zero financial expertise, zero market timing, and almost no active management. It requires consistency only. What derails most people isn't lack of knowledge. It's lifestyle creep. Income rises, spending rises even faster, savings rate stays flat or falls. Every raise is an opportunity. Not to spend more, to save more. If you save half of every salary increase, your wealth trajectory changes permanently. Jordan gets a $10,000 raise, spends it all upgrading his lifestyle. Alex gets the same raise, invests $5,000, spends $5,000. In 20 years, Alex's $5,000 invested annually at 8% becomes $247,000. Jordan's additional $10,000 in spending is long gone. The wealth gap between Alex and Jordan by retirement is not about luck, intelligence, or income. It's about one decision repeated consistently. What nobody tells you, the psychological reward of watching your net worth grow is more satisfying than any status purchase. It just takes longer to arrive. Financial freedom is not a number. It's the point where your passive income exceeds your essential expenses, and your time becomes yours. The 10 lessons aren't separate, they're a stack. Each one enables the next. Miss one, and the architecture weakens. The most important action right now is not complex. Open a tracking tool. Log 3 numbers. Start your savings rate at 10%. That's it for week 1. The biggest lie in personal finance is that you need to start with a lot of money. You need to start. The amount is secondary. There is no perfect time to start. The best time was 10 years ago. The second best time is right now. This is not a cliche, it is the math. I've been following these 10 rules for over a decade. The compounding, financial and personal, is real. It shows up slowly, then all at once. Let's close the loop on Alex and Jordan. 20 years later. Same starting salary, same city. The gap is now $640,000. Jordan has the car, the VIP memories, the lifestyle. Alex has $640,000 more in net worth and the option to stop working in 4 years. Jordan isn't a bad person. Jordan made the decisions the entire consumer economy was engineered to encourage. That's the system. The 10 rules: condensed, delay gratification, track 3 numbers, simplify your ETFs, avoid finance depreciation, hold for 20 years, save first, invest boringly, ignore peers, reject the 30K trap, personalize your risk. None of these require special access. No insider knowledge, no hot tips, no expensive advisor, just discipline applied to proven mechanics. If you do nothing else today, open a net worth tracker, calculate your savings rate, and automate 1 investment contribution. That's enough to start. If this changed how you think about money, share it with someone still stuck in the 30K millionaire loop. It might change their trajectory. Subscribe if you want the next system. We're going deep on ETF selection, tax efficiency, and what the Vanguard data actually says about portfolio construction. The data was always there, the rules were always available. The only variable was whether you chose to apply them. Now you can. Most people saving aggressively for 6 years still end up with $101,000, and 77% of it is still pure savings. The math hasn't changed. Have you?